Over the last 2 years, the majority of the real estate investment trust sector has been taking a beating. Just looking at the Vanguard Real Estate Index Fund ETF, we can see that after REITs recovered from the pandemic plunge, things began to take a downturn starting in late 2021. Since March of this year, Vanguard's REIT Index Fund hasn't been moving much up or down, rather it's just been moving sideways. Other alternative asset classes, including business development companies, and really just the broad market overall, have been recovering this year. As an investor myself who holds a lot of REITs in my portfolio, it's something that I've been keeping my eye on for a while. The truth is, there's been a couple issues facing the REIT sector right now, so in today's video, we're going to cover the issues that these companies are dealing with right now, and I'll also give my opinion as to when I think this sector will finally start seeing a good recovery. And then I'll also present a few REITs that are so heavily discounted right now that they're offering exceptionally high yields and have good growth potential. So with that being said, let's get into it. As we're all aware, the federal funds rate is currently very high, and in fact it's currently at a 22-year high, and when interest rates are high, this has several negative impacts on REITs. The biggest downside to high interest rates is that companies cut back on spending, and thus expansion slows down for these companies. This creates a unique problem for REITs because real estate investment trusts are required by law to pay out 90% of their earnings to shareholders in the form of dividends. By doing this, these companies are able to save a lot of money on corporate taxes that they're not required to pay. But when you pass on 90% of your revenue, it doesn't leave much left over to further grow your business. So by nature, REITs tend to borrow a lot of money to fund new building acquisitions or even construct their own properties. As long as interest rates remain high, REITs are going to have a harder time growing their portfolios or upgrading their current buildings. Borrowing money with interest rates this high is going to result in higher interest expense and thus reduce income. Another issue that creates difficulties is that interest expense on a REIT's existing debt might also increase. If a REIT holds any floating debt on its balance sheet, then this also increases expenses as interest rates rise. Floating rate debt is basically debt that costs more as interest rates go up. When interest rates were low, it made sense to take out floating rate debt, but now that rates are high, it can become noticeably more expensive for a REIT. It is pretty rare for a REIT to have a lot of floating rate debt. The overwhelming majority of the debt that I see is typically fixed debt. But I have seen some REITs that hold a decent amount of this kind of debt. If you've got a company borrowing millions of dollars, then a few percentage points of increased expense can cause a headache for a company. These two issues have been widespread across every type of REIT, but there's one sector in particular that's been suffering the most, which are office REITs. The S&P 500 Office REIT Sub-Industry Index is down almost 50% since early 2022. This is due to all the media coverage surrounding vacancies in office properties. In many markets like San Francisco and Chicago, office property vacancy rates are currently at an all-time high. Many office REITs and REITs that hold at least some offices in their portfolio have been seeing their occupancy ratings decline. This has made it more difficult for these REITs to cover the dividends, and as a result, some of them have been slashing their distributions. For example, one office REIT that's been suffering astronomically is Office Properties Income Trust, ticker symbol OPI. After suffering for many years, in early 2023, the company was forced to cut their dividend, going from 55 cents per share to 25 cents per share. Another office REIT victim is Hudson Pacific Properties, ticker symbol HPP. For many years, this office REIT was doing really well, having a good amount of share price appreciation and some dividend increases. But starting in early 2022, this company just cratered on itself. In just 1 year, their share price has fallen by more than 49%, and they've cut their dividend by 50% back in June. It's a really sad story about a company that was formerly great but have suffered significantly in our high interest rate environment. Some of these REITs have been selling off some of their properties in order to reduce the debt that they have, but this is also going to reduce the amount of revenue available to pass on to shareholders. It's very likely that the issues facing the office REIT sector are going to continue in the foreseeable future, but the problems in this sector are not going to cross over into every REIT sector. There's a lot of different types of REITs that hold a variety of different property types, including data storage centers, apartments, convenience stores, self-storage properties, among many others. A lot of these sectors have remained strong with high occupancy ratings, given how just in demand things like data centers and apartments still are. But the most important question here is, when are REITs going to recover in share price? In order for that to happen, we're going to have to start seeing some interest rate cuts. Anytime Jerome Powell, who's the serving chair of the Federal Reserve, gives a speech on interest rates, the market tends to react very quickly to it. If Powell emphasizes that inflation is going down, then the market tends to rise with optimism. If he suggests that inflation is taking a lot longer to go down and that more interest rate increases might be needed in the future, then stocks tend to fall on that news. It is concerning how much one person's words can have on the overall stock market, but every time he gives some kind of speech or presentation, the market reacts accordingly to how positive or negative this guy is. Most REITs are currently undervalued right now, and a handful of them are significantly undervalued. Because markets are efficient, once the environment favors REITs, then a lot of analysts are predicting a recovery in this sector. But until the feds begin lowering them, I don't think there's going to be any widespread significant recovery. As far as when rates will go down, the main driver is inflation. In July, it was announced that inflation had finally reached a 2-year low of just 3%, but because the Federal Reserve targets a 2% inflation rate, they still have a little bit of ways to go. Powell has said that all options are still currently on the table, including a potential small rate hike again later this year, but they do hope to start cutting rates next year. With the majority of REITs falling in share price, it has created some great opportunities to pick up shares at a huge discount. There's a number of high-quality, high-yielding REITs out there that have many years of consistent growth available. A high-quality REIT that's fallen hard because of interest rates is Crown Castle, ticker symbol CCI. This company operates and leases more than 40,000 cell towers and approximately 85,000 route miles of fiber supporting small cells and fiber solutions across every major US market. This company had a long history of growth and was trading at over $200 a share before interest rates started climbing. It fell hard due to cell towers being expensive to maintain and upgrade, but their dividend is still fully covered and they've continued to grow it every year since 2014. Right now their stock yields over 6%, and according to Seeking Alpha, its yield is at an all-time high. In my opinion, one of the highest quality discounted REITs available out there is WP Carey, ticker symbol WPC. They're a company that owns operationally critical pieces of real estate like government offices, warehouses, and even elementary schools. Their stock currently offers a dividend yield of over 6.5%, which is almost a 10-year high for this company with the exception of the pandemic. They recently became a Dividend Aristocrat after growing their dividend for 25 consecutive years. In fact, they've been able to grow their dividend every single quarter since 2001. One more REIT that's not exactly known for its growth, but it's currently trading at such a discount to their average that it could see a good amount of recovery, which is Starwood Property Trust, ticker symbol STWD. Starwood's currently the largest commercial mortgage real estate investment trust in the United States. This one's a bit different though in that it's a hybrid REIT, meaning that they invest both in physical properties and mortgage-related investments. They have a portfolio of over $28 billion across different sectors, including commercial and residential lending, infrastructure lending, and investment properties. Although they haven't grown their dividend since 2014, they've also never reduced it, and it yields much higher than average at over 9%. STWD typically trades between $22 and $26 on average, and it's currently undervalued according to their financials. So once interest rates go back down, then the share price of STWD could see a really nice recovery. Despite the share price declines across the REIT sector, most of them besides the office REITs are still doing really well. The biggest issue for the majority of REITs out there is just panic. People are overreacting that things are going to go downhill for these types of investments. But even with rates being at a 22-year high, everything has kept moving forward for most of them. Should the economy get worse, then there's two additional types of REITs that I normally advise people to stay away from. The first are hotel REITs, which can really suffer a lot when people can't afford to take vacations. Not to mention all the competition they're currently facing with Vrbo and Airbnb. The second type I avoid, with one exception, are experiential REITs. These are companies that own casinos, amusement parks, and other entertainment venues who can all really struggle during hard times. The only one I really like in this sector is Vici Properties. But overall, like I said, the majority of REITs have continued to do just fine, especially for the dividend aristocrats like Triple N, Federal Realty Trust, and Realty Income. The share prices of these REITs will recover, and until then, a lot of what's out there is currently at a good discount. But with that being said, that's going to wrap up today's video. If you're interested, feel free to check out my Patreon, where you'll find an Excel sheet of all of my holdings updated monthly. Plus, it'll give you access to our Discord channel where we discuss higher yielding types of investments. With that being said, thank you all so much for watching today's video. If you liked what you saw, then feel free to hit that like button below and click subscribe if you want to see higher yielding investing strategy content. Again, thank you all so much for watching today's video, and until next time, take care.